So let me just go very briefly through what I think is the cyclical picture in each of those parts of the world. As I said, the US, I think, is absolutely critical, and this, again, is illustrated by the performance of financial markets. This is a chart I love, and I've been using, and I think it's held up pretty well for the last 4 years, and I've been using it with clients since I first noticed it in about 2011, which shows you how the peaks and troughs of all those 4 lines coincide to within a month. Now, what are those 4 lines, for those of you who can't see? The black line at the top is the change in US monthly payroll employment averaged over 2 months, right? So every peak is when the employment growth in the US reaches a peak. Then every time it slows down, you have that black line going down. The other 3 lines are stock market indices, and interestingly enough, not stock market indices in the US, but in the rest of the world. So the red line is the world MSCI, the green line is Asia ex-Japan, the blue line is Europe. And what that tells you is, for example, that even in Europe, the ups and downs of the stock market have been much more dependent on a single statistic from the US, the monthly payroll employment, than anything going on in the Euro crisis in Greece and Spain or Italy. At least from the point of view of global asset and global investors, the risk-on, risk-off trades have been very, very strongly determined by what's going on in the US, and I think we've seen that again repeated in the last 6 weeks after the very weak payroll, very poor payroll figures in January and the disappointing ones just last week. So what can we say, I think, with reasonable confidence about the US? And this is where I think we get to not just good news, but fairly reliable good news. The US, I think, is still clearly in a cyclical, in the midpoint, in the middle rather than the end of a cyclical upswing. The reason I think for being confident that the US economy will perform better than in the next year and 2 years than it has over the last 3 or 4 years is, well, I'm going to give you at least 3 factors in the US economy that I think we can be very confident as continuing cyclical drivers. The first one is fiscal policy. For the last 4 years, the US has been undergoing a significant and in the last year, really quite a huge fiscal contraction, very much oriented to the spending side of the government balance sheet. In the last year particularly, the reduction in government spending alone took about 1.5% of US GDP. What this chart illustrates is that if you exclude the effects of reductions in public spending on the US economy, the US has already been growing at a 3.6% annual rate for 4.5 years, since the end of 2009. The only reason that the US headline growth figures have been as weak as they have been, 2.5% on average since the end of 2009, at least sort of mechanically, arithmetically, you could argue that the only reason for that has been the continuing squeeze on public spending, which was, of course, necessary because there was a huge upsurge of public spending in 2008-9 as part of the stimulus plan. But that squeeze is now over. It's now clearly and definitively over, and actually this week was the ultimate confirmation of something that I've been saying in my columns and to our clients for the last year and a half. The budget battles, the serious budget battles in the US really ended with the fiscal cliff deal in January last year. And from now on, there will be no further changes in fiscal policy and no further struggles in Washington between the Tea Party and the Democratic administration. And that was really definitively confirmed just the day before yesterday, when the House and the Senate both passed debt ceiling, a clean, unconditional increase in the Treasury debt ceiling, an outcome that most people thought was inconceivable as recently as a few months ago. So we can be pretty sure that that squeeze, which has taken US GDP down by an average of 1% over the last 4 years, is now over. The second factor, which I think we can be pretty confident about in the US, this has got stuck for some reason. I think they're done. If you can get it to work, otherwise I know what the slides are. Oh, why didn't it do it for me? Okay, sorry. Yeah, the next factor we can be pretty confident of is the housing market. There's already been a big housing recovery in the US, but if you look at the chart at the bottom, which shows residential construction in the US as a percentage of GDP, what you can see is it's certainly hooked up quite strongly in the last year and a half, but it's still far below, not just its average, but far below the lowest points ever registered in previous economic cycles. So from peak to trough, from 2007 to 2010, residential construction fell from 6.5% to 2.5% of GDP. Fell by 4% of GDP, took 1% out on average each year. For the last year and a half, it's been rising by adding about 0.5% to GDP every year. And I think looking at a chart like that, that blue line there, we can be pretty confident that that pattern will continue for at least the next few years. The third factor that I think can give us confidence about the cyclical upswing is that household leverage has normalized. At least it's back to a long-run rising trend, which is arguably has been too steep, but which I think is related to structural changes in the financial markets, low interest rates, and so on and so forth. Corporate leverage has been completely eliminated in the US, as it has been in much of Europe. So the deleveraging process, while it may continue, is not going to continue at anything like the rate that it has over the last 4 years, and therefore, in terms of deleveraging, what matters is the rate of change, the rate of change of the rate of change, rather than whether there is some net deleveraging. I think we can be very confident that the US credit system and the amount of leverage in the US economy has now at least stabilized and is no longer going to be a big drag on economic growth. So I think if you put those three factors together, fiscal policy, housing, and leverage in the credit system, you can be pretty sure that the US economy is going to be stronger in the next 2 or 3 years than it has been in the last 3 years. Whether it will be 1% stronger or 0.5% or 1.5%, I don't know. But the argument for a slowdown seems to me to be very, very weak. What about the rest of the world? Well, in the rest of the world, obviously the situation is not nearly as positive in Europe, but actually if you look at the upside potential, it's very considerable. And some economies, this just shows GDP per capita, the way it's evolved since 1993, and you can see that really it's only, you can see the peak that occurred in 2007, and you can see that it's only really the US, Canada, and Germany that have yet reached its pre-crisis peak. All the other economies are well behind in Europe, but Japan at the bottom, red line, has now exceeded its pre-crisis peak. And so what we see going on in Japan, and I think more recently in the UK, suggests that other economies, once they start to acquire a certain amount of momentum, are much more likely to accelerate, at least for a year or two, than to fizzle out, which has been the concern. Of course, the rest of Europe, the Eurozone, still has some very severe problems, and I'll come back to them briefly right at the end. But cyclically, the picture is pretty clear, it seems to me, that the worst is over for the Eurozone as a whole, and for parts of the Eurozone, including, importantly, not just Germany, but Central Europe, Central and Eastern Europe, which is very, very locked into the German industrial production scheme. There is a lot of upside in the years ahead. This, I think, is an interesting chart, which I put in because I think it's particularly relevant to this audience here in Prague, which shows what has happened to competitiveness, as well as, which I think is another big factor, at least for Central Europe as a whole. Now, in the case of the Czech Republic, because of the strength of the exchange rate, it may not be quite such a powerful story. But what this shows is that if you look at the trade-weighted real exchange rates of a group of Central European countries against their Asian industrial competitors, they lost competitiveness at an enormous rate between 2003 and 2008, and all that competitiveness has now been regained. So I think that creates a pretty good platform for recovery, as I say, not just in Germany, but also in Central and Eastern Europe. So US accelerating, Japan and the UK following, and Europe at the very least stable. But of course, the bad news about the world economy, which used to be the good news about the world economy, is that the US and Europe are a less and less important part of the entire global picture. And I think this chart is quite striking, which simply shows the share of the US and Europe in global GDP and the way that that's fallen from nearly 70% in the 1970s to roughly 45% today. So the 55%, or if you include Japan, say the 50% of emerging market activity is at least as important as everything I've talked about so far, potentially, and it's the part of the world that we know much less about, and now, for the first time, is generating real concerns. In my view, though, the chances of an exogenous shock originating in the emerging markets that is powerful enough to send the US and European economies off course, it has to be recognized, but it's pretty small. And the main reason for that is that there's only one emerging market that is actually big enough to have an impact on the world as a whole, and that is, of course, China. And the other emerging markets, as I'll say in a minute, are a very, very diverse group. So it would be extremely bad luck. It is possible, but it would be extremely bad luck if all or a sufficient critical mass of these emerging markets all got into a process of contagion at the same time, where they're all simultaneously collapsing to an extent deep enough to cause a problem to the global economy. China, though, is, of course, a problem. And the problem that everybody focuses on is basically illustrated by this, that credit has been growing by 20%. The Chinese authorities are determined to slow down that credit, particularly the blue line, which is the unregulated shadow banking credit. And in that process, who knows whether they will be able to maintain even the lower level of 6.5% to 7.5% economic activity that they're aiming for. My view, and here I'm really talking, I'm really conveying the view of my colleagues. My firm is based in Hong Kong. We have 10 people in Beijing who run a business called Dragonomics, and they look at this very closely. Our view is that actually the risk of an exogenous shock from China, either as a result of a collapse in industrial activity or a financial crisis, is very low, at least for the next 18 months to 24 months. We're not saying that everything in China is fine or that it's stable or balanced, but it's become very clear, I think, especially since last November with the third-party Congress there, that the authorities, especially the government, but to a lesser extent also the People's Bank of China, which is not really an independent central bank in the way that we have in Europe, but is an agent of the government, it's become pretty clear that the authorities have recognized a potential clash between two objectives, both of which they firmly believe in, but which they may not be able to achieve at the same time. One objective is to restructure the real economy away from excessive dependence on exports and heavy industry infrastructure investment and make it more of a consumption-oriented economy. They genuinely want to do that. They're genuinely determined to do that, and they're moving in that direction. A second objective is to restructure their financial system and slow down the growth of credit, and particularly unregulated credit. And incidentally, that's all embraced. And the third objective is that this all has to be done in an orderly way without creating a crisis. So they've got these three things, all of which they really want to achieve. And as long as they feel they can achieve them all at the same time, they will. But if these objectives come into conflict, which they did last June, July, after the first tapering panic, and to some extent they did again in December, January this year, if these objectives come into conflict, in our view, it is very clear what the order of objectives will be. The lowest level, the least important objective, is the restructuring of the credit system. The most important objective is preserving at least a degree of economic stability and maintaining the 6.5% to 7% growth rate. And the middle objective is continuing to restructure the real economy. So they'll try to do them all at the same time, but if they see the threat of a financial crisis, they will pull back. They will allow an expansion of credit growth. They realize that that's risky, but they know that unlike every other emerging economy, they can afford the time to take that risk because they have $3.5 trillion of reserves, which other economies don't have. They have a large current account surplus, therefore they're not dependent on inflows of finance, and importantly, they still have a totally closed capital account and a regulated financial system, which means that they can stop financial crises with an instruction from the central committee rather than relying on market forces. So they want to introduce more market forces. That's a good thing that they ought to do, but that's what also creates the risk of a financial crisis. And in our view, for the next 2 years, they're determined to avoid that risk. And that's why we're not worried about an exogenous shock from China. And we don't think that what's going on in the rest of the EM world is so serious, and I think this has been confirmed now by the stabilization of the last few weeks, that it's so serious that it's going to cause a major shock to the world economy. The result is that if you look at the world economy as a whole, the new normal, many of you have heard this phrase new normal that was coined by Mohammed El-Arian of PIMCO, and the argument was the new normal was going to be much slower growth, much more like Japan in the 1990s than the US or even Europe in the 1990s, and it's going to be very different from the old normal. But interestingly enough, if you look at the balance of the world economy as a whole, with the growth of the emerging world and the slowdown, the gradual slowdown of Europe and the US, even in the last few years, apart from the obviously extreme crisis year of 2009, even in 2010, 11, and 12, the average growth of the world economy as a whole, which are the red bars, has been only slightly below the 30-year average of roughly 3.5%. So the new normal, putting all that picture together, is not that different from the old normal, and it looks like we're now in the early to middle phase of a global cyclical upswing rather than at the end of it. So that, I think, is the broad cyclical condition. Now, just for the last 5 minutes, let me go back to the bigger, more speculative question of what are the structural forces? Are the structural, is the structural momentum likely to win over against the structural obstacles, or the other way around? Well, I've been fairly bullish in the beginning part of this, but I've got to recognize that there are a number of very serious structural obstacles that are still out there that are actually even beyond all the other things that we talked about. One, I think, is what's going on in Europe. In Europe, the cyclical situation has stabilized, but the structural condition, especially of the Eurozone, has not been resolved at all. And in fact, the cyclical stabilization has allowed Europe's political leaders to avoid the questions which were on all our minds a year ago, and somehow to dodge them and pretend that they don't have to be answered. But sooner or later, these questions will have to be answered, and I think they're pretty well summarized in there. What is required to make the monetary union work in the first place is actually 4 different other aspects. Fiscal union, and that incidentally involves not just the control of fiscal policy, which is the German conception of fiscal union, but a degree of joint responsibility of debt, which is the other side of the fiscal control. The rest of Europe is not going to agree to centralized fiscal control if it isn't matched by a degree of mutual responsibility for debt. So that whole question has not even been discussed. The banking union, I'm sure you've all been to many lectures about it and so on and so forth, but the fact is what's happened so far is not remotely adequate. It'll probably be sufficient to keep things together for another year or two, but it won't be enough to deal with another crisis if it comes along. What we've also found is that there isn't even really a proper monetary union in Europe, because you have a monetary union without a real central bank that has the same ability and powers of central banks in every other economy. And what we've discovered is that the most crucial feature of a central bank in a severe financial crisis is the ability to act as a lender of last resort, not just to the banking system, but absolutely critically to the sovereign state. It doesn't have to be directly through direct financing of the budget deficit, But the ability to buy government bonds without limit has really been what distinguished the Fed, the Bank of England, the Bank of Japan from the ECB. And we're nowhere near that. They're not something that's even discussed. And of course, all that can only be discussed within a context of democratic legitimacy, which means a much greater degree of political union. So the fact that all these issues have been sidestepped, I think, is a serious structural threat and impediment to the future of Europe. The other really serious structural impediment, and this is really the last point I'll make, has been the incredible divergence that has occurred between the debtors and the debtor and the creditor countries of Europe over the last 4 years. When you see a chart like that with the unemployment rates of the red lines, of the debtor countries going one direction, of the creditor countries going down, that is a chart that screams unsustainability. This is a process that cannot go on. At some point, it will either reverse of its own accord, or it will lead to the union breaking down or falling apart. So how that is going to be resolved remains to be seen, and so far, there seems to be nothing in the cyclical outlook and nothing in the policy framework that guarantees or even gives any encouragement to the idea that those lines are going to close. And if they don't close, you're going to see as I've put it in one of my columns, you're going to see the economic crisis in Europe metastasize like a cancer into a political crisis. The beginnings of that process is probably occurring right now and will be visible in the European elections in a few months' time, with nationalist, xenophobic, anti-European parties becoming not just increasingly powerful, but potentially really dominant in the political systems of a number of key countries, including France. So the European situation, while it's cyclically stabilized, is unsustainable. On the other side, though, I think you have a story about emerging markets in China, which goes way beyond any of these concerns about credit instability and so on and so forth. And this is illustrated by this kind of schematic that my colleagues and I have been very keen on. And it's called, in France, it's called the acceleration principle. And it's the idea that if you have a broadly normal distribution of income with a big concentration of people in the middle of the income range, you increase the average income by 10%. What that means is that you increase the number of people under the tail, on the right-hand tail, not by 10%, but in the case of this illustration, by about 700%. So you increase the average income by 10%, but you increase the number of middle-class Chinese or Indians by 300, 400, obviously it depends on the income distribution. It's just to illustrate that concept. So the rise of the Asian middle class, it's a story that may have slowed down, it may be interrupted for a year or two, but it's a huge structural factor that potentially is going to overwhelm, in our view, everything else that's going on. So let me just end with, where does this all get us to? And this, Marek was kind enough to refer to a book I wrote about 4 years ago called Capitalism 4.0, which laid out this sort of rough schema of how the history of the last 150 to 200 years, really since the invention of what I would call modern capitalism in 1776 by Adam Smith, of roughly, a very schematic outline of economic history of the last 200 years. And what you see is that capitalism has gone through a series of phases where each of these capitalist systems has been almost unrecognizably different from the one before. They've been punctuated by crises. They've had certain features in common, which I would say are the fundamental features of capitalism. Respect for private property, the ability to compete in reasonably free and open markets, and the power of the profit motive. These are the key features of capitalism, which distinguish it from communism, feudalism, tribalism, and all kinds of other modes of social organization. But subject to those three features, property, profits, and competition, there are many, many different ways that capitalism can work. And what we've seen is that there have been a series of systemic crises, and I identify 4 of them there in red. And out of each of these crises, really a fundamentally different system has evolved, so that what people thought described as capitalism in 1960 was completely different. It was unrecognizable from what people described as capitalism in 1925 or 1930. And equally, it was unrecognizably different from what people described as capitalism in 85 or 90. And I'm suggesting, perhaps, as I say, rather speculatively, that the crisis that we've seen over the last 4 or 5 years is perhaps the fourth of these crises that leads to a systemic change in the nature of the institutions, the relationship between politics and economics, between governments and markets, that is comparable to what happened in the 60s and 70s with the Great Inflation, in the 20s and 30s with the Great Depression, and in the middle of the 19th century with the era of revolutions and civil wars. What this new system will look like, which is the question I always get asked at the end of these talks, I have no idea. But I think that the key change is about the relationship between government and business, between free markets and regulation, which has gone through a series of pendulum swings, another of which we're seeing now. And if you want more details, all I can recommend is that you buy one of these books. Thank you very much.